Oh, the problem. Okay.
Maybe a key. Well,
Oh, there you go.
oh, it's open.
Awesome.
Oh, thank you. Thank you very much. Okay. I think there. Okay. Well, good morning, everyone. So first of all, they want me to pass this around for a sign-in sheet. Oh,
I'm gonna have to admit her.
that's the part of it. But I'm gonna be talking. Oh, this is signing sheet passing, going around, Luisa asked me to get you guys to fill it in. At 11:15 or so, we're serving pizza and hot dogs. And soda and potato salad, so after that, you'll be more than welcome to eat, stay and eat if you want. It is gonna be a pretty open conversation, raise your hand, call my name, whatever, if you have any questions or comments. Most of the time, I'll answer the questions on the spot. I'm pretty good about that. And if I don't know the answer, I will find it for you, either by the end of this class or later on. So that's gonna be rare. I'm pretty much gonna give you that info today. So today I'm gonna talk about non-QM products. But before I do that, for those of you who do not know me, look my little fancy gadget. Whoa. Well, that sucks. Oh, admit, remember admit. That's why. Hey.
Hey, how are you? I'm fine.
Oh, everything's frozen. There you go. Okay, for those of you who do not know me, which a few of you might not, this is me, that's my background. I also used to be the in-house lender here until I decided to go on my own, which I'm doing now. I have my own company, mortgage lending company. I focus only on mortgage lending. I don't really focus on real estate. That's Luisa's problem. So that's what I'm here today. I was asked by Luisa and Stephanie to teach and inform you about the non-QM products and what is the non-QM product, right? So that's the definition of it. It's basically, so here, there's conventional loan product, your regular 30-year fixed rates, FHA, VA, 15-year rate, 15-year mortgage. Those are traditional, meaning that they are approved and underwritten with conventional methods, income, assets, FICO score, credit history, so forth, right? The non-qualifying mortgage uses non-traditional methods, as you will learn today. For example, if a client or a buyer cannot verify income, just be they're self-employed, like all of us, in a sense, and they don't show income in their tax return, there are loans for those clients, and that's where it falls under the non-QM, non-qualified mortgage. It's pretty much these loans are funded typically by large pools of investors. And they do so because, as you will learn later on, the interest rate is higher than conventional loans. Why is that? Because it's a little riskier. Because, for example, you're not verifying income, you're using other assets or other factors to approve the loan. So the rate's always going to be a little higher. And for that, investors, private big pool of investors will put their money in these type of loans, but they're going to get a good ROI, return on their investment. So far, so good? I'm going to be stuttering today. So let's get started. Again, if you have any questions, raise your hand. Okay. Let's talk about the most, by the way, I arranged the slides into products that are really relevant in today's market. These are the ones that are being used a lot, and they probably, hopefully, I picked the ones that have real meaning to you and your buyers. Oh, sorry. Yes, I got you. All right. So this is like one of the best ones, DSCR, debt service coverage ratio. We'll go over the specifics in a minute, but what is it for? So you want to buy a house, you already own a house, but you want to buy a house, let's say you want to buy rental property, but you cannot qualify traditionally if you don't show income in your tax returns. But if you're a CPA or a doctor, whatever, you're a real estate agent, you don't show income, you have to take a lot of deductions. But this will allow you to buy that house because what it's saying is, if it's rental, let's say the mortgage payment in simple terms, let's say it's $2,000. So you know you can rent it for $2,300. Well, guess what? You'll get approved because they're going to use that income, rent potential future income, to cover the payment. Therefore, you don't have to go through traditional underwriting as to analyzing the rental, analyzing expenses. It's just as long as the rent can cover the mortgage payment, and I'm doing it in a very simple explanation. This is the loan that will approve that. Now we'll go over specifics. Yes, ma'am.
What would be the down payment?
Oh, so, well, let's do it. First of all, it's up to 3 million. Minimum FICO is 660. Another caveat is that you can make interest only payments. So if you know how to calculate interest only, we can. It's a lot smaller than a fully amortized payment. And I can show you that later on if you'd like. And you can also qualify with interest only payment, meaning because the payment is going to be smaller, it's easier to qualify that servicing rental, right? Let's say you're right on the border of, let's say the rental is, in our example, it was 2,000 mortgage or payment, and the rental is, like 1,900. But if we use interest only, that might work. Interest only would be a lot lower than fully amortized payment. If I'm going too fast, please tell me to pause down. Any other question?
Share this with us?
Huh?
Are you gonna send this to us?
No, yeah. Alright, so
Okay.
to answer that question, at the end of the thing, if you email me, I will send you a copy of the deck. That's the agreement. If you don't email me, I'm not sending you digitally. It ain't Christmas yet. Hello. So to answer your question, in this particular product, it's 35% down payment, 65% loan to value. So 100 minus 65, meaning it's 35% is the minimum down payment required. Now, as you see, in this case, it's going to be asset based or actually down payment based because they're not going to take a look at anything else. Not your tax returns, not your income. They'll ask if you're employed, but they won't get into any details because look at, you're putting 35% down. They figured, well, this guy ain't gonna walk out of the property. He's got 35% of invested in it.
This is primary. Or?
No investment.
So, and then what would be a typical, like, is it 10%? Is it like what you know what I mean? Like,
You mean rate?
Yeah.
So this program today is floating somewhere in the 8s and 9s.
Oh, really?
It used to be a year ago, it was floating in the 5s, 4
Oh,
and
really?
5s. Yeah. Well, in case you haven't seen, rates.
I know, but I guess, I feel like, I feel like the typical is like, I don't know. I just, in my head, like, if you get loans like this, it's always kind
Yeah, it could, and it probably will, as you know, in a couple of weeks. Good old Fed Chairman's gonna raise the rates again, right? So that's gonna have a trickle down effect in our mortgage lending rates eventually. Not direct, it is a trickle down, but it has, as you've seen, if you look at 12 months ago, we were at 3.5%, 3.8% 30-year fix. Today we are at, anybody?
7.1?
7.1, 7.2, 7.5. As of Friday, as of yesterday, 7.5.
Is there a lag time for these, or is it immediate, just like we see on traditional
Lifetime in.
interest? Like, going
Well, there's a little lag time.
Yeah.
But probably, there's a lag time, like 30-year fixed rates will go up right away, right? This will probably trickle down in a couple of weeks.
Okay.
Maybe sometimes 20, 30 days.
of. I have one more question.
Yeah. Good. Keep asking.
Well, hold on.
See, the back of my head is just gonna stop. What is that?
Oh, like, when, like, is there a refi? Is there like a refi time that you have to like,
A refi.
like
when you get out of.
Yeah. when
Oh,
you-
yeah, no prepayment penalty, so you can refi out of it anytime, you can pay it off. Yeah, there's no anytime. Well, I should say after 6 months typically. And then last comment here is you can pull up to $1 million cash out in hand if you use it as a refinance tool. If you want to refi into it, because that's possible too, right? You already own the property, but you want to refi and pull cash out of your investment, you can use this product to do it. The high rate is higher, but for some possible reasons, it could be worth your while if you need that money. And then you can also get up to 40-year fixed interest only payment. So it can really lower your payment. Great for investment product. You get 40 years instead of 30 in interest only, especially those clients who are looking to flip the property in what, 2-3 years or less? Great. And they love the interest only because that's all they're gonna really do. Because they're counting on the flip to make their money because they're gonna sell it for a much higher price. So far, so good? Man, killed it on that one, huh? See, every time I do yeah, see, I gotta, sorry guys, I gotta keep doing this every time. We let somebody in. There you go. There's your 2-1 buy down. Everybody's talking about a 2-1 buy down.
Yeah.
Like Gladys Knight, everyone's talking about 2-1. Everyone's talking about, what's a 2-1 buy down? So I'm gonna start from the bottom, because this is the part that is not being, from what I'm hearing out there, it is not being stressed upon as critical information to you guys. The cost of buying down the loan is paid by
The seller.
Yep. And Jojo, what is that cost? It's typically about 2 points or 2.5 points to do this product. So if you've got a $500,000 loan amount, that's about $10,000 that you're gonna have to ask the seller to cover for you, isn't it? And so I'm gonna jump one step ahead here. Has anybody heard yet that coming up soon that they're gonna ask the buyer to pay the commission of the agent?
Yeah.
So that's gonna suck, huh? Well, in this case, in this example,
Why would it?
because you can't put it on the loan. The buyer now has to come up with down payment, closing costs, plus your commission. So they may not have those funds. So you're gonna tack on another, and it's irrelevant in this case, but that's just a point of convention and thinking, like, it's great for the seller, but for the buyer, they may not have all that funds. But in this case, going back to this example, it's paid by the seller. So let me go back to the top. Oh, somebody had a question. Conventional loan guidelines are used for the 2-1, just like any other 30-year mortgages, for purchase only. However, it's also available on FHA and VA loans for primary home only, no investment property. And it's the rate of, let me see here. Oh, let's talk about the rate. So let's say today's rate is 7.5, and they went ahead and got the 2-1 buy down, seller's gonna pay the cost. So what happens? So 7.5 in the first year, the rate will only be what?
5.5.
5.5.
Yeah.
The second year, the rate will be what?
6.
6.5. And in the third year, what will happen to the rate?
It goes to 7.5.
Exactly. See, you guys are good. Who said coffee? You don't need coffee here.
So let's say,
So, yeah,
so I have a question. So let's say if the interest rate will go down, let's say you're going to 4%. Let's say it goes back to 4%. Will they be able to get that lower rate?
Wait, one more time.
Will they be able to get that lower rate? Or do they have to refi out?
Wait, what do you mean by it goes down to 4% and then you lost me?
No, okay, if it's 7.5 this year,
Mhm.
and let's say in January, it goes down to like 4.5.
Oh, no, you're stuck with the 7.5.
You're stuck with
Mhm.
that. Got it.
You won't get the market adjustment. You can refi it
Mhm.
for sure, but that's your rate.
Mhm.
Okay, and where was I? The borrower is qualified on the actual note rate of 7.5, not the 5.5. And that's important to note because if they can qualify with the 5.5, better chance of getting qualified. But no, they use the 7.5 rate.
just going back to the point is, after the 2 years,
Uh-huh.
right? I just want to stress that point. So after the 2 years, you're stuck with the 7, but you can refinance
Mhm.
with a lower rate. at that
If the market is low,
point.
yeah.
So you're not stuck with it.
No.
Okay.
You can refi, you can pay it off, you can sell the house, whatever. And because here, the last comment is no prepayment penalty. So you can pay it off, refinance it, so forth and so on. Everybody good with this? The 2-1 buy down, any questions on the 2-1 buy down?
Mhm.
So one of the things I'm teaching the agents that I'm working with on the 2-1 buy down is, first of all, if the client decides that they want this product, have that conversation at the offer stage. Because if not, and also have that conversation with the client, Mr. Client, if the seller says no, you're gonna have to get the regular loan, so don't count on this thing, it is subject to the seller saying yes. Now, there are tricks to the trade that are legal, I shouldn't even say tricks, but there are ways to get the seller to agree If you'd like to have those ideas, give me a call. It's a private conversation. I'll show you how this is typically sold to the seller, and it works for both sides without anybody, or actually it works for both sides of the aisle, seller and buyer. There's ways to do it. This is not a new product, by the way. I was doing this product back in the 1980s. And I was still 10. What do you got there, huh?
These days,
Oh, yes, I was drinking back then, so yeah. these days. Okay, everybody good? Next product. Another very attractive product today. So let's take Mr. Dr. Jojo, who makes $500,000 gross income, but when you look at the statutory, it shows 30,000 adjusted gross because he takes deductions up to the zoo with his corporation and all these golfing expenses and travel trips and so forth. So he doesn't show any income basically on the statutory, but he needs to buy a piece of property. He wants to buy a piece of property. But we know because he's a doctor, he does earn the money. He gets paid a lot of money every month. And Dr. Jojo, what does he do? He puts that, he deposits all that money in the bank every month. He's probably, let's just see, let's take a surgeon. He's probably depositing, I don't know, $50,000 a month in his bank accounts on average, give or take, right? If he's making $500,000 a year. This program will work for him because what we do, let's jump right into it. They will ask the client for the last 12 months of bank statements, minimum. They will look at the line item called deposits. And then they will take that total deposit for the month minus any, actually, let me take it back. It has to be deposits. They're going to calculate the deposits, but they will audit it to make sure that it was actual deposits, not transfers from another account. Those transfers are not allowed. So, but if it's actual deposits he made, then the bank believes that he's actually making that money deposited into the account. So every month the deposit becomes his income. It's actually a little bit more, they actually calculate what they do. They'll add up the deposits for 12 months total, then divide it by 12, and that's the average income that they're going to use for him or for the doctor. Yes, ma'am.
So I can't see somebody putting that much money into a bank account every month without putting it into investments. Will investments count? That's
Yes,
where he can become liquid in those investments?
not
so
to
that people-
qualify, his investment will be used for reserves. Now, I say to you, because I've seen it, people that are really earning a lot of cash flow, that's not unheard of to have that kind of $30,000 or $40,000 in deposits every month. For example, I give a different, not the doctor, and that I had a client that owns a patio building company. A lot of money comes in, a lot of money comes out also, but a lot of money comes in. But we don't care about the money coming out per se, we care about the money coming in. So she's running about $35,000 in receivables income in this program. Now, there's a little bit more caveat to this. Obviously, I'm giving you the most simplest explanation.
So they're not looking at just the NOI.
No, but they are looking for, there is one more caveat that, where is that thing? They will ask the client CPA to write in writing, to put in writing, what is the expense factor for the client? Okay. So if, let's say they're making an average of 10,000 and the CPA says, oh, his expenses are about 25% every month, we're going to use 7,500 to qualify him. That's the caveat. But again, there's little tricks of the trade to that. When you run into this client, I'll teach you the tricks of the trade on this program. All right, so what else? Minimum score is 660. That's important, right? Because if you don't have 720, 740 score, 660 is a great number. Up to 15% down payment or 85% loan to value. So 50% down, they can use the program to buy the property. Up to $3 million. We can use personal or business bank statements. So the client could be using, or might have a business account, a corporate account, or maybe not, just using, like my client on the patio, he was using his personal account to run his business too. It happens. Not ideal, but it's available. And there must be at least 25% of the business owner available in 30 and 40 year and interest only. And you can use the cash out if you're using it as a refi for reserves. And we talked about it a second ago. You got to have some reserves money on this, at least 6 months of payments. So if you've only experienced 3,000, you got to have at least 18,000 left if you're buying a house
In the bank.
in the bank. It's not too much unless you're buying $1 million property, a couple million. But that's
And
called
so
the
you
back
said
statement.
it has to be sitting there for the last 6 months.
No, it's actually 2 months is the minimum. And you can even get away with 30 days. Or if you're refinancing, the cash out you're getting, it becomes your reserve. Right? Is that okay? I haven't lost anybody, have I? A lot of technical crap in here.
Are you still, you know, want to do your fix? Cause, Cindy was saying that she's not doing that anymore now, she's doing,
We'll get to that.
okay.
We'll get to that. And that's, yeah, we'll get to that.
I have a quick question, is there any penalties if something's paid off earlier?
Nope. But most products today don't have any prepayment penalties. Rarely that it does. And the one occasion that it does is like maybe hard money. And you can talk about that also. Somebody remind me again, hard money, because it's a very relevant product today. I've been doing a lot of that. Okay. So far, so good?
Woo-hoo.
The 1099 loan program. Here we go. Another doozy. So basically, they don't show any money in the tax return. They're self-employed. Let's take an actress. They make good money, but they are 1099. They're not a W-2 employee. They're not salary. They don't get pay stubs. At the end of every project, they get a 1099 for that $1 million. And guess what? This program, all we do, we'll take 2 years worth of 1099s, add it up, divide it by 24. That's their income. 1099. Any self-employed person that's getting 10, we get 1099, don't we? Yeah, this is the program. So minimum 680, 25% down payment. Blended income means that you have different sources of 1099. Let's say you're an actor, but you're also a hairstylist and you also do nails. We can use all of that. Being facetious. We can either do 1 or 2 years of 1099. Why, Jojo? What's the difference? If you do 2 years, your rate is a little better. Because that means you can show track record of that income. Remember, who is the bank or whoever funding this wants to mitigate risk. The longer history of income, the more they feel it's reliable, consistent, and it may continue to come in. But 1 year is fine. Tax returns are not required whatsoever. The debt to income ratio is 55, higher. So because typically the normal is what? If anybody knows what's the normal debt to income ratio of conventional loan? Anybody? Huh? What? 45. 33, you're right though. That's technically correct, but 45 is the max push. Interest only payments available up to 3 million. Now, Jojo, is it only up to 3 million? No, there was no 5. It's just a give and take on cash rate. 3 million is probably the average and the most attractive pricing today. That makes sense? Hello. Is somebody logged in?
Yeah, I love somebody. Jimmy Stewart's on the phone.
Oh, what happened? No, I can't do it. Oh, shoot. Sorry, ladies and gentlemen, here we go. Okay. I put this slide up here because this product just came out. Somebody was asking about adjustable. So adjustable rates are coming around the corner like no tomorrow. It hasn't been for the last 10 years or so, right? Because fixed rates have been low. But now adjustables are coming back in. And real brief, I'm not spending a lot of time on ARMs today, but they come in 1 year. Sorry, they come in 6 months, 1 year, 5 year, 7 year, 10 year. And I'll explain. So let's take the, forget about the 1 year term, let's take the 5 and the 10 and the 5, the 7 and the 10. That means that for 5 years, the rate is fixed and it becomes adjustable. 7 becomes 7 year fixed, becomes adjustable, 10 year fixed becomes adjustable. Jojo, how does it become adjustable? Well, it takes an index, and we're not going to get into that, it's very technical. There's an index interest rate out there that they use, LIBOR is one of them. And plus they add a little bit of a margin and that becomes the rate, but it will adjust depending on like this particular one, it says 1/6, right? That means every 6 months, this loan will adjust. Whatever the market is in every 6 months, that will be the new rate. It is becoming attractive today because they can get the 5, the 7, and the 10 year fix before it becomes adjustable. Because they're thinking, clients are thinking, well, I'll probably wait. I mean, that's a good question. What is the average hold time of property today? 5.5 actually, but that's okay. 7 is good. But you see the argument there though. If you take 5, 7, and 10, and your hold time is 7, well then probably if not sooner, you get the fixed rate protection and then you sell the house. However, has there been problems before? Yes, of course, because if you, I don't know how long you've been around this planet, but I remember it only was 18% rates. So that could be a problem. That's a big jump from 7%, right? Anyway, it's becoming more attractive. This is one product that came out the other day. Okay. Ooh, the doozy. This is the bad boys of loans right here. Bad boy. This is the bad boy. So what does that say up there? What does that mean? Huh? Yes. What else? Any other comments? Huh? Oh, yeah.
Jojo's going to 2000.
2008, baby.
Here we go.
Yeah, but the percentage rate on it is way higher than a normal
Sure.
loan.
Sure. I'll let you guys digest that for a minute before we take a dive into it. All right, so number one, income documentation not required, no pay stubs, no 1099, no tax returns, no W-2s, nada, right? They don't ask. Income is not even written on the application. They don't put any income in there. Zero. There's no employment information either, none. We don't calculate debt to income ratio. No, we don't. Don't worry, there's a little caveat. The credit is based on, first of all, FICO, reserve liquidity, and LTV. Here it is, reserves, how much money you have left,
Okay.
and LTV. So the minimum down payment, ladies and gentlemen, is 20%. If you have 20% and you don't show anything, ba-boom. Oh, this sucker is like heavy today, boy. We're doing these deals like no tomorrow. Oh, here you go, Emilio. The bank, the money can only is in the bank only 30 days.
Wow.
Wow, oh, cartel money coming in.
Yeah.
Here we go, baby. You can tell I'm Miami dress today, so. Loan amounts up to 3 million, and if you're gonna use it as a refi, because you want to pull money out of your house today to buy another one. That's a 70% maximum loan to value to refi your house, right? And full cash. And then you can turn around and use this program to buy the house.
Wow. Wow.
So much.
And look at the FICO, guys. Woohoo! Now, 640 rates are gonna be really high. The preferred, the sweet spot is 700 or 680, I should say. If you have 740 though, that's really very good. You're gonna get a really good rate. What are the rates today, Jojo? They're floating at 9s for this program. Now, there was a time a year ago when they were floating at 5s. Now they're at 9s. Those rates have gone up, but it's out there. We do it. I've done it. So if you don't remember anything else today, remember the Miami loan.
Yeah.
What's up? Sweet, huh?
But there's no reason not to be able to get anybody financing now.
That's why I always tell every agent I work with, it may not be a client right now, it could be a client 3 months, 6 months from now, or if I go non-QM, they could be a client now.
Yeah.
So it helps. Oh, that's what I forgot to say this morning. Why are we here? It's exactly that reason, because you might have rejected a client before because you didn't know about these loan products. Client said, well, I don't really show any money. Whatever. I'm self-employed. Well, today you're learning. It's possible. It's almost they've got what? So they got what?
20% down payment.
Cash. Exactly, 20% cash. As long as they got change. Cash is king. I always say that. So far, so good today? Okay, what's next? Ooh, this reminds me of the 80s for sure. BOE, what is BOE? Verification of employment. So in summary, before going into detail, and guys, I'm not teaching you to do anything illegal or anything that's out of compliance. These are actual products out there. I'm not making this shit up. Verification of employment, meaning you don't have to provide any income documentation as long as your employer is willing to sign the verification of employment form saying Jojo De Guia makes $10,000 a month, has been with me for X number of years, whatever. Good to go. I know, look at that. So, but what are the caveats? So first of all, there's restriction. They have to be at least 2 years with the same employer. And they gotta be able to show some reserve with 2 months of bank statements, right? And that's not unheard of. 20% down payment for purchase and refinance, maximum 70% loan to value for cash out refinance. BOE completed by borrower's company, first time home buyer, okay. Maximum loan 5. Woo, look at that FICO score, man. They're really going crazy this time around. So Jojo, I'm gonna go back to the 80s fast. No, guys, because look at, have you seen 100% financing anywhere yet?
No.
No, they got money, they're on money, skin in the game. If you put 20% of your hard-earned money, let me tell you, you're gonna do your best to keep that house. Make sense? Oh, God, what other tricks do I have in my sleeve today? Jesus, we're going to hell and back with these kind of loans. There's no forgiveness now. Any questions? No, good. What's next? Foreign national, so it's a little faded, but so you get a client from, I don't know, whatever, abroad that wants to buy here, doesn't really have a, it's not really a resident of the United States or green card, anything that through foreign national, they can. 30% down payment, that's always something. If you have 30% down payment, it's the client, yes, good to go.
So Jojo, right now I have a deal going on in Colombia. She wants to put that money back over here. She could go with something like that.
And even if the money's not here, so the problems that they encounter here is where's that money sitting? So if it's not sitting in the US yet, it's still doable. It just takes a little longer time. We got to go to Colombia to verify it. And then we got to get it translated in an embassy because it's typically going to be in the language of the foreign country, right? Spanish, not so hard, but what if it's Iranian or whatever, any kind of other language, right? And then it's available for second home and investment property. You notice that it's not available for primary. Why is that? Because the theory is that they're a foreign national, they have a house in their own country. So they have to say they're buying a second home or investment. Because if they say it's primary, now we're going to get a call from the Homeland Security, aren't we? We have a non-citizen looking to buy a primary home over here. So it has to be second home or investment. And there's and just so last comment is you can buy second home investment 2 to 4 unit condos, non-warrantable. What is a non-warrantable condos? Anybody know? What's that? It means condo that has problems with it, that cannot be a conventional financing. It's not a lawsuit, doesn't have enough money in their HOA, that kind of crap. There's a lot of products that you can use under that, and one of them is the DSCR, the most popular one. So they use this product under the foreign national program to get the client qualified for a financing. You remember the DSCR, the first product? Yeah, that's the most common one they use. But the takeaway is 30% down for a foreign national. Sure, no problem. It's sitting in Medellin. Sure, no problem. In the jungle, maybe no problem. We got that joke. Thank you. Moving forward. What's next? Oh crap! Just when I said there's no 100% financing, what a liar! What a POS, not point of sale. I am. So there is 100% financing, guys. True 100%. It's available for first-time home buyers. It's also available for first responders. Actually, it's available to anybody as long as you do the class. There's a class, home buying class required by the federal government. It's under the FHA loan program, and real quickly, typically an FHA is 96.5% financing. You have to put 3.5% down payment, right? So in this program, the 3.5 is either given to you as a grant, depending on where you're buying from, whether city or county, or it's given to you as a second mortgage. That's the most common, a second lien on the property, and typically no payments. You just have to pay it back when you sell the house. So basically in this scenario, the buyer only has to come up with closing cost money, but they still have to pay that. And here's some of the caveats. Obviously, primary residence only, not a vacation home in Malibu. Suckers. Minimum of 640 FICO, but the higher the FICO, the better the rate. First time home buyer, okay, you gotta do the homeowner education. It's FHA loan. What else is, and you can add, and the seller contribution, up to 6% is allowed. So, do the math, I got 100% financing, I just need 15,000 for closing. Guess where that money can come from? Good, it sounds good. Yeah, now it's a 200% financing, isn't it? And but the seller says, Jojo, I'm not gonna do that. Wait, let's have a little private conversation, Mr. Seller. I'll tell you how you why you want to do that, how you can do it. That's a private conversation. Call me. Anyways, DACA is also allowed. You know what DACA? The individuals, right? Everybody know what DACA is, right? So I don't remember the definition, but like the individuals that were not green card or resident alien, but they were inducted into the
Program.
immigration program because they've been here for so long. A lot of the kids, especially children, were born into here, but still the parents didn't have, it wasn't documented. They were put into the DACA program and officially. Okay, everybody good? How am I doing on time? Good. Ooh, it's up. Okay, so we're in the back end now. This is still around. It's not being used a lot, but it's really not a bad program, but I'll tell you the goods and the bad. So 3% down payment, right? You might, and typically the ones that are doing this the most are the banks, the big banks, because they're required to do a lot of this loan based on their bank compliance guidelines. It's 3%. The restrictions that you will find here is it has income. That means there's a certain median income that it cannot exceed, somewhere around the $70,000 to $80,000. And what sucks about that is if they cannot exceed that, then they can't really qualify. So it's not being used a lot in the high purchase ticket areas. In other states that have a much more lower average price, $300,000, $350,000, very popular. With an $80,000 limit, they can qualify with that purchase price. But you can't, an $80,000 limit on your income, it's very hard to qualify for a $600,000, $700,000 home, especially with today's rates. The other restriction is where you can buy. So they limit it to certain areas, and the government actually has a guideline as to where these loans can be used. It was for the loans were really designed to invest in communities, the underserved communities. They were encouraging people to buy in those communities, and doing so by providing a loan that has a very low down payment. And again, the banks do it. They have to do it. They have to do a lot of these loans. Okay. What is that? God, these people are going crazy today. No FICO? What kind of criminality is this? So there is a product out there for FHA and VA, no FICO. There are some caveats, obviously. The first one you're gonna see is the maximum debt to income ratio on a regular FHA loan is what? 50. But on this product, it's limited to 43. So that's one of the restrictions. But yeah, if you don't have a FICO, no minimum credit scores. Oh, I tell you. Boy, Stephanie's gonna say, what did you teach my agents today? They've got to have a 12-month of housing payment. So if they don't have any rental history or whatsoever, they've been living with parents, got to be a problem. So it's really, so there are some restrictions, right? So you got to have, like, you have to be able to show that you've been able to pay rent for the last 12 months. And 43% ratio, and you got to have 2 months of bank statements to show where your down payment money is coming from in the reserve. FHA requires 2 months of reserves. VA almost pretty much the same, but this one they want 24-month payment history, because why? VA is 100% financing, isn't it? And here's what's another good thing about the VA? Who can tell me? Besides 100%. Oh, the back of my head again. Who can tell me? Another great compliment of the VA loan. Well, you're on track. There's no mortgage insurance.
Yeah.
FHA has had some mandatory mortgage insurance payment. It could be anywhere from $300 to $500 additional every month. VA, no, because it's insured by the Veterans Administration. Yeah. Heck, I would.
I should definitely use it.
And the rates, by the way, on the VA loan is very attractive in compared to today's conventional rate, right? You can still get like, if it was 7.5 for conventional, they're at 5.5, give or take.
Get an
Under
income
VA.
from and live in one of the units and get
Mhm.
this. Yeah, I should.
Everybody good with that? So you probably will not run into this a lot, but today my goal is to share with you options. Expand your horizon. You know, drink every kind of brand of tequila, not just Jose Cuervo. Nasty. Nasty. All right, good. We're coming down the line. What's next? Oh, God, you get more tricks than you can handle today. Out of the box, these are just additional stuff that you ought to know about, or at least be kind of, at least hear about it. Let's start with, huh?
580, really going to well. today.
Oh, it is a 580, by the way, today. If you have a 580, so like a lot of agents that I work with, Jojo, what if it's 590 score? Don't worry. By the way, I have taken 580 scores and got it to 660 in 30 days. Why? Because I've got an excellent credit repair guy, which I will not share with you, but that's why you don't know.
Really?
Hello, bah humbug.
You just gotta come in.
Now, if you were my client, of course, you get to use those goodies. Yes, sir. Oh, yeah, really. All right, so let's talk about the one of the most important, ITIN. What is ITIN? Anybody know?
We didn't have a green card, so they're kind of like a.
And they don't have a green card.
Oh, yeah.
Yes.
It's your tax ID.
It's an individual tax ID number. They have applied for a green card, but it hasn't been approved. They get an ITIN, individual tax identification number, but they can still buy if they've got 20 or 20% porciento. Another good one in here. Oh, look at this. If you've ever got a client that wants to build their own home, and they're not very strong, they have not a lot of down payment, they can do the FHA one loan construction loan program. Little quick history on construction loan. When you're doing a construction loan, you have to actually get two loans. It's typically called the construction loan first to build it, and then you get a takeout loan to become the permanent final mortgage loan on the property. It's very tedious, a lot of processing, and again, there's two loans being done. Two underwritings being done. Basically, one for the construction, then a secondary for the final or permanent loan financing. The FHA one loan construction loan really? The one loan basically is one loan from start to finish. And a fixed rate too, right? For that matter. What are the downsides? Well, it does have mortgage insurance. But it will fund a construction of a new piece of property from start to finish. And the second restriction is maximum is falls under the limit, which is like around 920,000, something like that. So, what else? We just talked, you already, oh, look at that. What's that thing up there? Yeah, can you believe that? 80% on the first, 20% on the second. It's 100% financing. Wow, we're going hell and back now. But the rates are high, and they gotta have a lot of reserves, money in the bank, left over. Where's another? Oh, this has already happened. Fannie Mae to allow adding rental history to credit report. So, clients that are FICO score challenged because they don't have a lot of history. Fannie Mae is now allowing the rental history to be counted as part of the credit history. It never used to be. You already know about the down payment assistance program, the 100% that I talked about. So I think that's it. The NINA, it's still out there. Look at that. No income, no asset. Oh God, you're really going to hell today. No income, no asset is allowed. There is a program out there for it has to be for non-owner occupied, meaning investment property. It's out there. 15% down payment. Gotta have 700 FICOs.
700?
Yes, ma'am. Just click it. No income, no asset. Holy moly. Everybody good? We're almost there. It's just additional names of the products we already discussed. Different banks and lenders will brand their own product, but it's the same. I'm just giving you other language that they use to talk about them. You see the 12-month bank statement, ITIN loans, asset depletion. We've already the 1099. We talked about that. Oh, That's why that 10% jump. So if you don't put 20% down on a conventional loan, you're gonna have to pay what? Additional. Correct. Now, there is called, write this down, because nobody's using this, and I use it all the time to analyze payments. LPMI. Lender paid mortgage insurance. So rates today are 7.5%. Let's just argue that's the rate today. But they don't, clients don't want to pay PMI. It's another $200 additional. The LPMI program will bump the rate maybe a 0.25% or 0.375 higher in lieu of the PMI. Higher rate, but no PMI payments. Sometimes it makes a lot of sense when you compare. So LPMI is out there. And that's also very important. If I'm trying to qualify a client, but they can't qualify the ratios because of the mortgage insurance, I will immediately run to LPMI to see if I can remove that mortgage insurance and get them qualified. Little tricks of the trade. And you thought it was just good looks and good clothes. All wrong. All right, we're in the last couple slides. We have a tremendous library of flyers. If you email me and send me your contact info and your picture, it looks the kind of just this is an example, but this time around your contact info will show up here. Very professional. You can do it in less than a day, do it in 10 minutes, but could be drinking tequila. But anyway.
Is there a charge for it?
Huh?
Are you charging for it?
Oh, you, I'm gonna charge you. The rest is free. Everyone else is free. But yeah, we have hundreds and hundreds. This is like one of them. As I send out, it's available in print and also JPEG, so you can post it on Facebook. It will add, again, it will have your information on there. It's very factual information. It changes every week. There's a monthly version of that also, plus all kinds of other flyers which I'm not even showing today. So email me and you can be part of the the gang. What's up? Everybody good? And I think we're in the last. Yeah, we're in the last. That's me. So now I'll open it up to questions. Oh, you were listening. You get free pizza today. Hard money loans. So let's start first with the first restriction. It's got to be maximum of 65% loan to value or 35% down payment. Absolutely no questions whatsoever. Credit's not even an issue. They don't look at credit, they don't look at employment, they don't look at income. It's called a hard money loan. It's typically only for 2 years max or less. That means the guy, the private money lender wants his money back in 2 years. He can pay it off anytime, but he wants it all in 2 years. The rates are right now, they're floating around 10%. But if someone really needs it and they own a piece of property with a lot of equity, this is your guy. It's typically done and funded in 2 or 3 days. Kind of like if you heard about bridge loans, similar concept. No appraisal is ever done, typically, no. They just, as long as they can validate that there's equity in there by title searches and so forth, market valuations and so forth. Hard money is there, done it a lot. Quite a lot. Other questions? Good actually. No, nobody? Zero.
Would it make sense to like get a hard money if you want to buy a property, but you didn't qualify, and then once you got it, then you can just rebuy it and then pay off the hard money?
Yes, but you remember the hard money has to, it's real estate based, so you've got to own a piece of property somewhere.
Right, so it could be secondary and like once you can't take out.
Mhm.
I know,
Yes, enough, let's say you own this piece of property right here, let's just say, let's say it's your own property, but you have so much equity, right? You can do a hard money loan on that, take that money and buy another home. But you obviously, you're gonna have to pay it back in 2 years. Yeah, no problem. No problem. Other questions? How hard is it to go to Costco to try and I mean, recorded. Wow. I'm in trouble. Any other questions? Because it's your time. I'm pretty much done. Like I said, email me and I'll send you the deck for today, or else I'll put you on the flyer list, whatever. If you send me your photo and contact info.
Can you please send us slides
If you email me, yes.
Find them, you pulled out the sign the street. You got an email.
Yeah,
I got
email.
You respond back with it.
Just water information. We have to reach out.
Okay, I'll email you.
With a pro quo.
Yeah, Georgia's hard, hard.
Nothing is free in this world.
For the, hard money loan,
Mhm.
you pay monthly until it's paid. You pay-
Oh, yes, you pay interest only monthly, interest only, it's the only thing required. Until you pay it off. Absolutely, and that's a lighter load than fully amortized payment. Question, where's that list, by the way? You're gonna have to give that to Luisa.
Oh, I'm sorry. I never.
Oh, the sleeper here.
She was gonna take it.
Here's the pen.
Thank you.
Any other questions before I adjourn? Okay, so the next class is going to be probably next month. And I think, what does she want to do next? I'm not sure what the one is, but it'll be interesting again. There'll be a lot of information like today. So talk to Luisa, we'll keep an eye out for her email because she wants me to put on one in November and another one in December.
Thank you.
All right, well, thanks for coming. Stay here with pizza and hot dogs and soda, potato salad. No, it's pretty good. There's potato salad. I'm making that up. All right.
Thank you.
You. Now, how do I do this? Stop sharing first. Good. I'm gonna say adios and meeting.